Okay, everybody, thank you for joining the webinar around ASC 606 disclosures, observations, takeaways, and samples for 2018 of SEC filings and comment letters. This webinar is actually one of a series, and the purpose of the series for Softrax is, as many of you know, we provide automation solutions around ASC 606 and revenue recognition in general. We've been taking keen interest in these SEC filings and comment letters, assessing them against our strategic roadmap, etc., but also realizing that there would be a lot of interest in corporate finance, in terms of what the SEC is paying close attention to, etc. So as far as today goes in presenters, you have myself. My name is Tom Zowley. I'm the Senior Vice President and General Manager for Softrax. And with me is Kristen Lawson from our sales engineering team. Kristen's a CPA and deals with revenue recognition issues across our client and prospect base. Just a little bit on Softrax, for those that don't know who we are a division of a company called AFS Technologies out of Phoenix, Arizona. We are based as a division in Boston, Massachusetts. We've been involved in the revenue recognition space since the 90s, and have offices throughout the United States and throughout the world. As you'll notice from the next slide, our customer base, very interestingly, has primarily been in the technology vertical up until recently. I would say up until 606. And the reason for that is because software and some of the other technology areas had very complex revenue recognition, and obviously in the United States, this is industry-specific guidance. However, with 606, we see that complexity migrating across a number of other areas, and we have started to sell our solutions into areas like media. You see DexYP here, franchisors, which would, Duncan would be an example, as well as continuing to sell into the technology vertical. So the agenda for today, in this first webinar, we're going to focus on, we've done an introduction to the series. We're going to focus first on just some general observations regarding all of the man hours we've put into looking at these SEC filings. We'll provide, toward the end, some samples of some real financial statement disclosures so you can see what others are doing. As we get further into the webinar series, we're going to start focusing in on more specific comments that the SEC is making. One broad point I will say is that in May of this year, the Chief Accounting Officer for the SEC said that they would not come down hard on companies. The reality is we are seeing some of that occur just as of the last month, and so future webinars will focus on that. With that, let me turn it over to Kristen to talk about some general observations.
Hi everyone, this is Kristen Lawson. Thank you, Tom, for introducing the webinar series to us and what we'll be talking about today. And again, the first thing I'm going to cover is just some general observations that we've been making as we've gone through some of these SEC filings. And the first observation that I want to bring your attention to is the presentation of ASC 606 information, because here we've noted what we've found is that most of the meat, or the qualitative information, which is where you can find each company's story of adoption of ASC 606, is found most frequently under these headers and section names. So when you're looking through these filings, this is where you can find the information. So you see recently adopted accounting pronouncements, recently adopted standards, summaries, maybe an impact of recently issued accounting standards, and even in the notes and the footnotes. And it's actually interesting that we found also that these ASC 606 references and disclosures are presented in multiple sections of a company's filings. So because the guidance does not actually prescribe a specific format for presentation, companies do have that flexibility to cover their bases and help readers avoid the nuisance of having to pivot back to earlier portions of the filings by utilizing those multiple references. The SEC main's goal, obviously, is transparency and consistency for shareholders, but I would think that these references are more facilitatory than prohibitive for shareholders understanding business practices. So we found inclusion of ASC 606 information in existing notes and footnotes, as well as entirely new sections as well. And we'll discuss disclosure formats actually a little bit later, but next we're going to jump into observations on transition approaches. So for those who aren't fully aware, there are two transition approaches in terms of adopting ASC 606, and that's the full retrospective method and the modified retrospective method. And actually, per a study done by Deloitte, 85% of those in the study use the modified retrospective approach, which is a big portion.
Yeah, and it's interesting because I would say that the full retro ended up being more complex than we even estimated, particularly from the point of view that, well, a lot of people think of it as a 3-year restatement. I mean, between open contracts and everything, a lot of the people that adopted full retro, I mean, they were going back 3, 4, 5, even 6 years on these things. And between that and processing all of the changes and adjustments and everything else to restate the revenue, I mean, it is a chore. So it's not surprising that 85% went modified.
Yeah. And that's really big in some of the disclosures too, because they're having to cover all those years. Another thing that this Deloitte study mentioned was that, in our next bullet point, we're talking about variable consideration that was frequently covered in these filings. And they noted that in general, the revenue disclosures were 3 times as long as they have been in prior years, which in part is due to that variable consideration piece. The qualitative narratives on variable consideration contributed, to that length, and it's because they're answering questions on how, when, and why that consideration was accounted for under the new guidance. Now, on the contrary, quantitative information was not as guaranteed. And that's not to say that they aren't presenting their numbers, but more to mention that supportive disclosures have leaned more towards that more robust narrative instead of the quantitative information. Okay. So the next big observation is around the disaggregation of revenue. After reviewing the filings, it was not really a surprise to find that the attributes most frequently used to disaggregate revenues were product lines and geographical regions or business units. Those two seem to be applicable to business units, our public businesses across all industries. But what I think is more distinguishing is the fact that the vast majority of those entities chose to use 2 or fewer categories to disaggregate. So if you think about it, companies aren't diving any deeper into understanding on a contract level what's going on, but rather keeping the high-level perspective, allowing more flexibility in that presentation. So because even though there isn't granular detail, each company's business model may vary quite a bit in terms of geographical locations and business units and products or services offered. So it sort of left us deciding that disaggregation may be more of an art than it is a science. Think broad brushstrokes rather than paint by numbers.
Yeah, and I think, one of the things that we're going to try to do in subsequent webinars in this series, I mean, we're certainly seeing all the SEC filings, the company filings for the SEC. We're now seeing the SEC comment letters back, and one of the things that we're trying to understand ourselves, and I think would be very valuable to summarize for others, is what are the trigger points? So, what in the actual filing is causing the SEC to come back with a particular comment? I would say we're starting to see patterns now, but certainly by the next month or two, the next couple of webinars we do in this series, I think we should have a much better feel for that.
Yeah. And so in that last bullet point too, again, I just wanted to mention that we've been seeing more qualitative input on disclosures than we have on quantitative inputs. And this is talking about practical expedients, which we're actually going to expound on here in the next couple of slides. But I just wanted to point out that we were still focused more on those qualitative narratives. Okay, so the first practical expedient that we're going to talk about actually is related to a significant financing component. And, just in brief, it reads, an entity need not adjust the promised amount of consideration for the effects of a significant financing component if the entity expects at contract inception that the period between the entity transfers a promised good or service to a customer when the customer pays for that good or service will be 1 year or less. So that was very long-winded, but the key there was 1 year or less. And per our review, very few companies actually identified that they met the significant financing component requirement. And most of them identified that they either did not have a business model that intersected with the requirement, or if it did, the time frame was less than a year, thereby allowing them to take advantage of this practical expedient.
So I guess, Kristen, a question there. I mean, I recall when we were building out the functionality for the time value of money, there were a number of companies that felt like they would have this requirement, all of which had contracts well over a year in length, yet a significant number of them were able to get out of the requirement seemingly without meeting this practical expedient. So could you maybe comment on that?
Sure. You know, I mentioned that some people are saying they either identified with the fact that their business model didn't contribute to the significant financing component, or the time frame was less than a year. And I think both of those are at play. I think companies are either altering their business models to sort of equate this payment schedule with the transfer of value to the client. So i.e. there's no real financing benefit to either side. So that payment schedule is less than a year, or it coincides with that transfer of value to the client, or either the time frame was less than a year, so they are changing their payment terms so that people are paying every year so that they're missing that, or changing their contracts to be less than a year.
Yeah, that makes sense. Yeah, okay.
Okay. So the next practical expedient is actually on the cost to obtain a contract, the incremental cost of obtaining a contract, and it just reads that they may be expensed if they will be amortized over a period of 1 year or less. And we just wanted to note this because the complexity of handling the cost of obtaining a contract could be really high if you don't meet this practical expedient.
So just a question for you. When they think about capitalizing these costs over the life of a customer, is it, I mean, obviously it's considered to be a complex thing because I think there are a lot of people trying to apply the practical expedient. Are they having to, recast existing revenue? So let's say in a given quarter they recalculate a new average life of the contract of the customer. Are they having to recast the existing costs that are being capitalized over that term, or is it just on a go-forward basis?
Okay, so, I'm not exactly sure what the answer to that would be. That's something that I could definitely look into from an ASC 606 guidance standpoint. But just to, maybe back up for those who are less familiar with this practical expedient or with the revenue standard in general, essentially the new standard affects how companies are recognizing commission expense because they're being asked to recognize commissions at a customer level for contracts, over a year, right? Now there is guidance that relates to the fact that if a commission is renewed or there's additional commission expense later on for the same customer, that it's then expensed over a contract at a contract level. So you do have to realize that if you subsequently sell another deal under the same customer, but you are not actually providing that the same commission associated with that customer, then what you're asking essentially is, then do you backtrack and say we have to revalue the customer life, or do we just move on forward on a go forward basis for that contract? And I don't know that there's a definitive answer that I have for you, but we can certainly look into that moving forward. I think we will see some comments from the SEC on that as well. Okay, so this is a big one. This is about remaining performance obligations, so sort of that deferred balance, or what's left over as you perform that obligation. And it just reads that an entity need not disclose the information for a performance obligation if either of the following conditions is met. Either the performance obligation is part of a contract that has originally expected a duration of 1 year or less, or the entity recognizes revenue from the satisfaction of that performance obligation in accordance with paragraph 606.10.55.18. And I would say that this is one, if not the most common practical expedient leveraged by companies.
It's interesting to me because I read this and I would think, and I guess coming from an automation perspective, I would think that there would be not a lot of overhead, in fact, in doing this. I wonder if it's being leveraged right now just because, I mean, I know a lot of people had to adopt on spreadsheets just to make the adoption date, and I wonder if that's part of the driver here.
Yeah, I would totally agree. I would think that having a schedule of what's going on for remaining performance obligations just comes with, you know, an accounting territory. But another potential issue here, I think that we didn't think of originally, is disclosing this information about contract deliverables over 12 months could give away some competitive information that, you know, a company wouldn't otherwise disclose. So if you think about disaggregating and rolling forward the information at a performance obligation level, it's really just a lot of detail to provide to the public world.
That makes sense. I mean, that could be it right there. I mean, one of the things that I would say that it's certainly coming out in these reviews is, you know, from the comment letters, it does seem like the SEC is looking at all of the angles of 606. I mean, we've seen some comments regarding allocations, contract modifications, the need to state or disclose the balance of the contract asset and liability accounts. I mean, I think that, you know, I think these practical expedients are getting leveraged because there's complexity in each of those areas, but the complexity also, I think, for a lot of these companies, it's not additive, it's actually multiplicative. So complexity, you know, really ratchets up as they have to do, you know, these multiple things or meet multiple areas of the new guidance, and it's very new for a lot of companies.
Yeah. Oh yeah. Okay, so the next thing actually that we wanted to do, so the goal of this slide and a couple of the next slides is really to just present with you real life examples of how companies have formatted and presented their comparative results for ASC 605 and ASC 606, as well as the impacts. So here you can just see a baseline revenue schedule here. So you have ASC 606 as reported, the impact of adoption, and that adjustment, right? So you can see sort of a before and after picture of this income statement. So here's actually another example of quantitative information on this financial statement. It's obviously a little bit more of a table format. There's nothing wrong with it, obviously. It just provides sort of a different graphical display of what's going on. You can see previously reported, then with the adjustments, and as adjusted. So maybe a little bit flip-flopped from 605 to 606 for that Q1 2017. So this one actually, this one's probably my favorite because it's very clear. The headers are very clear in what's being presented. It says pre-adoption of ASC 606 topic 6, pre-adoption of ASC topic 606, and then the adjustments, and then as reported. I think this is very clear that one is 605, one were the adjustments, and one is now 606. All right, so just one more. This one's obviously very clear as well, but maybe a little more similar to that first one that I showed you with as reported, the impact of adoption and as adjusted. I think it's really just, we wanted to show you that there's no one-size-fits-all approach, and you know, as long as you get this information down in a clear, presentable format, that's totally acceptable, and that's generally what everyone has done.
Okay, so we're trying to keep these webinars fairly short. We'll cover, you know, topics similar to this, but probably get into some very specifics around, you know, specific comment letters that have come back from the SEC, and maybe talk a little bit deeper about what those comments mean in those particular areas of the guidance. So please keep us in mind for future webinars. The next one will be on September 18th. If you are currently either adopting the guidance or are seeking to automate an existing adoption of the guidance, definitely feel free to reach out to us. I mean, we've got a lot of experience in it. Our forte obviously is in automating the guidance via software solutions, cloud-based solutions. But between ourselves and our partner channel, we've built up a tremendous network of information and experience on ASC 606. And I definitely want to thank you all. Info@softtracks.com. And thank you again.
Thank you.